Right, so this session is going to be on income statements. Now, an income statement is a financial document that is done every year by a firm in order to recap the inflows and the outflows of the business. Now, it's not exactly like a cash flow forecast, which shows the inflows and outflows. It actually goes a bit more specific than that. It looks at the revenue that has come in, as well as all the costs that have gone out. At the end of the year, you'll be given a retained profit figure, which carries over into the next year of operations. So, here's an example of an income statement. And this one is done for 2023. Now, what we start with, obviously, is the revenue, which is the money that goes into the business. So, if the revenue is at 1,000, then that is how much revenue was made in 2023, 1,000. The cost of sales reflects the variable costs that go into the revenue that was earned. What does that mean? If you are a fast food company and you're selling burgers and French fries, then the meat, the potatoes, the cheese, and the drinks are what will make up the cost of sales. So anything that is related to the product is called cost of sale. So let's say in this example it is 200. Let's go 200. So you're left with then your gross profit figure, which is your revenue minus your cost of sales. So what is that? That will give you your gross profit figure. So here your revenue is 1,000, your cost of sales is 200, your gross profit obviously is 800. So now we have our gross profit figure. Let's put a line here and a line there. Now we'll go to our expenses. Your expenses are the rest of your operating costs during the calendar year. They include your wages, they include your electricity, they include your rent, they include any other costs that are incurred in the business. So in this instance, let's say it is 500. For your net profit figure, your net profit is your gross profit minus your expenses. It is the figure that will tell you how much you have made in a calendar year after all revenue and costs have been accounted for. So, what is it? 800 minus 500, which is 300. Now, the last one is tax and dividends. So at the end of the year, you're going to pay a tax and you're going to spread the money among the shareholders. So this is called tax and dividends. So it can vary every year based on each firm. It's always going to be different. But in this instance, let's say it is 150. Which will leave us with a retained profit. The retained profit is the amount of money that you're able to retain from your net profit. This is the figure that will carry on to next year's accounts. So how much is the retained profit? Net profit minus tax and dividends, which is obviously 150. So now we can decipher how the company has done over the course of the year. You can see, first of all, that they've made a profit. They're at a positive figure. They're able to pay their shareholders dividends, which means that the shareholders will be happy. But in order for us to do a full analysis of it, we need to compare it with another year of operation. So for example, if in 2024, your figure for retained profit is 75, that means that retained profit has fallen, and it also means that the shareholders are probably not going to be happy because they've probably earned lesser dividend because of the retained profit figure. So this is the income statement. We're going to move on to ratios in the next video.